Hello and welcome. For today's interaction, I'm joined by my colleague Chirag and Sailesh Raj Bhan, CIO-Equity Investments at Nippon India Mutual Fund. Welcome, Shailesh.
Thank you. Thank you for having me.
Thanks for taking the time out for this interaction. Shailesh, let's begin this interaction with, we would like to know a little about your journey in the financial markets. It's been quite impressive. Could you share with us how you first got involved in this field?
Yeah, so it's been close to 28, 29 years into 27, 28 years into equities.
Right.
So I graduated in genetics, did MBA finance, and then, at generally the start of equity research culture, we actually got an opportunity to work with an equity research organization in Hyderabad.
Mhm.
And from there on, then moved to Bombay and worked in research covering pharmaceuticals and IT services and consumer sector at the point of time. And then about 20 years back, 21 years back, joined Nippon Mutual Fund and have been managing money since the last 19 years in some of the strategies. So in a way, it was the industry was very, very young then, and
Right.
research generally had a liking for research, and you actually get to learn a lot of things fairly quickly. And I think you get exposure to a large number of sectors, large number of changes. In fact, virtually you can today sit and converse with anyone on any topic in the world. That's the advantage of being in this role. And you get to basically it was more getting new things to learn, so we never felt bored about what we were doing at all. And every day it had to be different. You had to be on top of what's happening around, so that kept us more alive than normally you would, when you're doing a thing for a long period of time. That created that interest. I started with pharmaceutical sector, which clearly was a very exciting sector in terms of the kind of businesses which were built in India at that point of time. It's possibly the first true make in India sector, which exports to 130, 120 odd countries in the world, right? I mean, it started way before, and it was always competing even in the global developed markets and based on quality. So I think that generated interest on scalability of businesses. How companies can really go global. And some of the best entrepreneurs also came from that space at that point of time when we started 18, 20 years back. And IT services also had a similar profile, so that continued to keep the interest high. And it was the time of those roaring growth rates in IT services, if you remember, 96, 97, 98. So that created that. And the good part of this whole thing was wherever we looked in India, even then and even now, there are multiple sets of opportunities. So everything you look, compare with what's happened globally, ever in a developed place on a higher per capita basis, you find every industry, at least 20 years back, was minuscule. Now it is small. So it's never, we've not arrived yet in terms of scale and all that. And that journey, I think, is very long. So you kept on getting on to learning retail, getting on to learning various other sectors as things progressed. And, that kept the interest and the motivation to do. So the beauty is, the good part of this is you get to learn something new every day. No day is boring. And that enabled us to keep the fire to be able to do this over the years.
Mr. Bhan, before joining Nippon Mutual Fund, you gained valuable experience working as an analyst with brokerage houses. Could you reflect on some of the key lessons you learned during that time? And how have you seen the markets evolve over your 3-decade journeys in the equity markets?
Yeah. So the initial phase was the core phase of learning research, in the sense you were to meet companies, identify them. At that point of time, equity research was not a very established field. So you had enough and more differences you could create by reading balance sheets better, meeting companies better, understanding competition better, and seeing the scale opportunity in front of it better. So the narrative from just near-term numbers and all that was what was causing a lot of noise there. But the focus there was to see, can you get the long-term picture right? Because we had seen that experience in pharma, seen that experience in IT services. So the research experience there clearly allowed, not just specific to those sectors. In fact, engineering, manufacturing companies then were trading at distress valuations even in 2001 and 2. And all these large businesses were at, because these were ignored in the IT boom. So all old economy was ignored in the IT boom. So you got an opportunity as head of research to work across sectors at that point of time. And you could clearly see cross-sectoral valuation gaps, cross-sectoral opportunity gaps which are there. And it was at that point of time possibly one of the most attractive markets ever was the post 2000 bust, because businesses were available at bankruptcy valuation and all that kind of stuff. That all again came about a few years back when you had this taper tantrums happening, and after the whole collapse of post the global financial crisis. So I think these kind of phases allow you, give you time to learn, because you really can research and choose the best businesses which are there. Second is you get time to research. It takes that amount of time to get a comfort and understanding of the long-term opportunity for a business. So in a typical bull market, actually the quality of research drops sharply. But we had a long bear market then, so that allowed that time and attention to be given to businesses, and you could learn across sectors. So that was the learning experience there.
How have you seen the markets evolve over the your extensive career?
So markets have been scaling up rapidly. The not just the returns which have come about, but more so the market infrastructure, the information flow. Earlier, to get international annual reports of companies, this is just the pre or early internet era. It used to be a problem. It used to be like you have to write to them. It used to come in after 30 days, and generally they were diligent to send it to you. Right. It was also expensive to send a courier to the US at that point of time. So from there on, when internet came, that became fairly easy. Internet was not in this format when it came. It was a very different structure. So you had to download reports in a text format in a different manner. But the kind of information flow then in that period from 95 to 2000, I think was extensive. The learning that shot up was then because we had access to every single report globally published. I'm referring to annual reports and material and information published by these large companies. And that really helped in scaling I would say, the understanding of businesses globally and locally. The minute you start seeing that, right, I mean, that shift, the minute you start seeing that, you could apply a lot of this to what's happening in India, what can potentially happen in India, what India needs to be to reach there. And that gave the confidence that it's a very, very large opportunity in front of us. And we had minuscule participation in equities then. There's no concept of SIP at the early part of it. Mutual funds were very, very small. So I think we were lucky to be in the right time in the market at the right place. I think that enabled sort of learning.
Mr. Bhan, you spoke about getting the annual reports from the US markets or from the global markets. How that journey shaped up, just wanted to understand what helped getting that reports and to change your overview of the equity markets.
Yeah, see, a few things happened was we could understand scale. See, when you're living here and you don't have so much access to what's happening globally, because at that point of time the information flow was not this seamless, right? And so that allowed us to understand that, say, a single product in pharma could be worth a few $1 billion. The whole Indian pharma industry was worth lesser than the single product sales of one of the large companies globally. So you could put things in perspective when you were able to go through that. Second, their business models. Those companies had evolved business models and different business designs than how India was. So you're able to differentiate and appreciate that even other business models outside your understanding actually can also work. And you were able to understand how Indian companies could actually shape up 10, 15 years out if they follow this. So in our engagements, when we used to communicate to managements and try to think, are they thinking 5 years ahead, 7 years ahead, 10 years ahead? If they're thinking, they need to be in connection with what's happening globally and get a sense of that. So that allowed us to differentiate quality of managements, people who are trying to build businesses with a 10, 20-year view, people who are taking the right calls at different points of time in terms of difficult calls or investing ahead of time. So all these things mattered, and I think that learning and access to global information in a very short period of time, for a 4-5 year period, was very, very beneficial.
So you've made a remarkable transition from being an analyst to a fund manager, and now CIO-Equity at Nippon India Mutual Fund. So over these years, can you walk us through this journey and how each of these roles shaped your career?
Yeah. I think the single most important part of the role which I have done has been research, because that, I think, is a platform for everything we do. And I'm sure there are many ways to manage money and many structures and all, but I think if you want to be doing it on a core bottom up point of view, I think the fundamental understandings on how businesses, companies, and industries shape up is critical. So I think that was, in a way, the foundation which enabled understanding businesses and how they look in a 3, 5, 10-year kind of a horizon. So that was one. Then we, at Nippon, we launched the Pharma Fund, which was my first responsibility. That's close to 19 years back.
Mhm.
And at that point of time, sector themes were very, very small. Only I think there were very few sector opportunities and sector themes there. And at a very early stage, we had the opportunity to participate in the pharma space then. That enabled, from there the fund management journey started, and then I moved to diversified funds a year after that. And for the last 18 years, running the Nippon. Earlier, it used to be the Opportunities Fund. It is now the Nippon India Multicap Fund. And post that, I graduated to running the Nippon India Large Cap Fund for the last 16 years. So the diversified funds came a little later in the journey. It started off with sector funds first, and then the diversified funds were an important part. Having a research background across 4 or 5 large sectors, which constitute 50-60% of the value of the market, I think became fairly useful and easy to transition into the role, right? And then then you get to learn a lot about the other sectors also, because they have to be an important part of your portfolio construct and long-term returns. Cross-sector comparison and where differentiated value lies allowed us to take some high conviction calls, because unless you understand different sector valuations and different opportunities and are able to place it in a framework, it's very difficult to take contra calls from the market. So the core of research enabled taking those specific calls, contra calls in the market, and having the big picture advantage of having access to global information flow in the 1995 to 2000 period also enabled to build a perspective where you could take a stand even if it is against the market. And those kinds of calls have actually benefited a lot in terms of the outcomes.
You have been a part of Nippon India Mutual Fund, which was earlier Reliance Mutual Fund, for over 20 years now. What has motivated you to stay with the same fund house for such a long period of time, and how has your career growth during this period?
Yeah. So I think the job itself is very interesting. So I said, you can get to learn something new every day, and every day you have to realize you don't know, very little about what is to be known. So whether it's start of the 20 years or today, also we are still in the learning mode, and that enabled the motivation to continue and the interest to be there. As an organization, we were very small then. We had maybe 200 crore worth of equity assets at the point of time. Today, we would have a significantly larger share. So, as an organization, we grew, and you kept getting opportunities also to participate in the growth. Obviously, you get learning from people who have been around you and seniors who have worked along and all that. So, that also enabled understanding the markets a little better and faster. So, that continuity also helped in terms of doing it. The core reason has been that you have been able to, on this platform, take right calls, differentiated calls. You've been allowed to uh, do investment across a large cross section of companies and businesses, and run your portfolios based on your conviction. So that, I think, is what keeps you motivated every day when you come here. So even in our team today, we enable that fund managers take their call based on their conviction, obviously within the risk management framework which we have built in. So the flexibility and the freedom to operate and take the right calls uh, also keeps your mind alert and also keeps you responsible for outcomes. So I think these two things have remained for a long period of time, and which we are enabling in our team as well on a continuous basis. And that keeps you always on your toes in a positive manner.
So when it comes to being an investor, how do you describe yourself, your approach, and your philosophy? And are there any specific types of stocks or market situations that particularly excite you? If you could give some anecdotes there, it would be great.
See, interestingly, markets are no different than life in the sense, they are like, people can have many ways of living their life, many ways of having their this thing. For us, what we see is what we can, when we see a business, one we see, is it a sustainable business which is there? Is it something which is a sustainable business? Is there growth in the business, and can it become materially profitable? Because end of the day, it's the profits that count over a period of time. So the basic idea is buying growth businesses at sensible prices, or sustainable growth businesses, sensible prices as we call it. We also believe that you have to take the right risk. Just being closeted to indices does not lead to any differentiated outcomes. And when investors are giving us money, they are giving us because based on research, we take the right risk. So the attempt is to take the right risk at most points of time. Third approach is not to disproportionately overpay for growth. The core principle is, even if you look at, even if you buy gold, at a much higher price than what's fair price, you end up losing money. So I think the fundamental thing is, if you pay well for growth, but don't overpay for growth just because there is momentum. So whenever there is extensive momentum, we try to step back, because that is where we think is our next 3-4 years end up to be challenging. Fourth is what is priced in. When you look at it, in a lot of cases, we end up seeing extraordinary businesses completely out of favor because there is no momentum available. That comes in cycles. So that is another anchor to our decision making. To your point, where you mentioned about what type of markets excite you, it's clearly bear markets. Right? You get to buy what you want to buy in so many and as much of quantity you want to buy. And after you buy, the stocks come down 10-15%. So that is where I think the biggest excitement is, because you can own what you wish to own, best quality, world-class businesses at sensible prices, you get them. Today in bull markets, you actually get very poor quality businesses at very expensive valuation. So I think it's just the inverted market we are in. So while bull markets are good for in terms of wealth creation and all that, but all the effort of wealth creation only happens in bear markets or difficult markets, which I think those are the markets which we love, because we get to do research, we get to understand what's happening in each of the businesses, we get to buy sizable bets without impact cost, and then we can see a 3, 5, 10-year journey. Simply put, let's look at it. The biggest bear market in the last 10 years has been in capital goods and engineering and manufacturing businesses in the last 10 years, right? If you look at it, people hated buying businesses in this particular sector. So you could end up buying the whole engineering sector in India at a market cap of maybe one IT services company or one consumer company. And India has 1.4 billion people. Their infrastructure is to be created. Manufacturing has to happen here. Everything was there. And these prices, as we speak today, a lot of these businesses were 1/10 the prices just 3 years back. And today it's talked about India as a manufacturing renaissance is coming and things like that. But prices have moved. So the idea is you get a bear market in these cycles. You get extremely dislocated valuations. And the same thing happened even in 2007 and 8, where only infrastructure was booming. So one single large infrastructure company had the market cap of the whole pharma sector in this country, which needs to service the 140, 130 crore people at the point of time, or the forever virtually. And I think that opportunity presented where you could actually sell infra businesses and buy the whole pharma sector significantly as a part of your portfolio. So these shifts are what we like, because they really give, with a greater probability of having positive and very good outcomes. In a bull market, when everything rises and you're chasing relative value, all your mistakes happen there. So these are markets where we worry about our mistakes, because they will determine how our returns come 3 years out. And as we see in today's markets, we are seeing a lot of misallocation of capital happening by investors.
Mr. Bhan, you spoke about, momentum. You don't like to invest in the momentum markets. And we can say that right now we are in a phase of a bull market or a market rise and a momentum kind of thing. So how is your business strategy at this point of time? What are the sectors you are looking? What are the sectors you're not looking? Because markets has been rising continuously for the past 2 or 3 years. So what's your strategy as of now?
Yeah. So clearly, this is a market, is a momentum market where there are fund flows determining near-term outcomes, right? So our idea is within this is don't dilute on quality. Say what's happening in a relative market. If a best company is valued at 40 times, everybody's saying that this is the 10th best company, but it should get 30 multiple. It doesn't happen like that. Because the best company will last for 20, 40, 50 years and continue to grow. That's why you're giving them a 40 multiple. For businesses which are fragile, we are today starting to give very high multiples is our worry. Right? So the idea is within that, try to go into a higher quality business. Even if you're paying a little more expensive for a higher quality business, it's far more worthwhile than just going down the quality curve for the sake of it. Right? So I think clearly we are seeing in the markets a lot of benchmarking, which is happening in a very casual manner. So a company with 2 lakh employees and an infrastructure and scale and maybe 50 years of history is being compared with companies which are 2, 3, 4 years of history and kind of being put a same multiple there. So I think that differentiation is what we are trying to bring internally to make sure that you don't end up buying fragile companies, right? Even if they are high growth businesses, maybe you buy a lesser percentage of them so that you don't add to the risk, because I think our investor expectations are more in terms of being more sustainable and delivering more relatively more consistent returns than just getting a one-time return which comes out of buying some of these fragile businesses. So a lot of attention towards getting. See, we cannot eliminate asset class risk, right? But within that, we can actually manage the risk. Even our communication to investors, I think, which is possibly the most important thing to look at, is towards saying that please don't run with expectations of returns which have come in the last 3-4 years, because those expectations of itself returns will actually keep you disappointed even if you have normal markets in the next 2-3 years. So I think that is a constant engagement and communication on seeing end customer outcomes are as per what they really want them to.
In your experience, when does a stock become a irresistible buy, and what are the key factors you look for investing in these stocks? I'm just asking you, can you just give the anecdote also, because you invested in the services sector, the hospitality sector stocks in 2016-17 when they are at rock bottom. So could you just explain that when the stock becomes an irresistible buy?
Yeah. Most of the irresistible buys, as you call, they come in their worst economic environment for that specific sector. So what happens is when you have a very bad cycle, a 5-year cycle, which is very difficult, people give up, investors give up, because a large part of money is benchmark money and people want to focus on getting the near term right. The minute they let go, the value of those businesses keeps coming down, and comes below their intrinsic value by a huge margin. And also because 5 years are bad, analysts cannot project a very strong recovery also naturally. And that makes it that our expectations run down, valuations run down, right? And the cycle which comes next is always way bigger than the previous cycle, because that's how the scale of the economy happens. And a lot of these irresistible buys are those which are non-replaceable assets. In the sense, you generally end up with saying that these kind of businesses with so much of long runway for growth in a bad cycle, who have put in thousands of crores of capital, are available to you. And nobody in the world wants to put money in that sector at the point of time. That's why you get these businesses at, so hospitality sector, interestingly, at that point of time, it was cheaper to stay in a hotel, booking it for 1 year, right, than staying in a rented place near that same location where the hotel is located, right? And the hotel was giving you, maybe they'll throw in breakfast free, maybe they will give you all other services free, and you have the whole lobby and infrastructure access of a 5-star hotel, and the valuations there were way cheaper than the amount of money you pay to stay on rent nearby, much lesser quality infrastructure. So these cycles come and they will repeat again. So it's happened in hospitality, it's happened in whole of manufacturing, the space, right? The world-class businesses thrown away because the last 5 years have been bad and you could end up owning it. It happened in public sector banks, extraordinary large-scale businesses. So there's another critical example of this. One of the largest businesses or banks in India with lakhs and lakhs of deposits, right, had similar valuation to businesses which had maybe just 1 or 2% of the scale of deposits that bank had. That was so close in terms of the valuation gaps which were there. So markets, either by momentum, either by flows, dislocates fairly frequently, and that is where the opportunity emerges. Unfortunately, this market is a horizontal bull market where everything is getting re-rated. So I think those sort of opportunities are a little limited than what they have been every time in the last 20 years.
And on the flip side, what are the characteristics of the stock that you would typically avoid adding to your portfolio?
Yeah, so clearly, if I don't see longevity in the business, in the sense, it's a very simple principle that the business should last beyond us. I think that is the starting point. But if you have longevity in the business, right, if that is missing, for example, that becomes a mistake, because it's very difficult to value those businesses appropriately. And that, I think, is a critical parameter. In addition to it, the ability of that business to generate at least a sustainable ROE, because otherwise it keeps on diluting yourself. So you start off with an X amount of capital, X amount of ownership in that business, and 5 years later you realize that because so much of dilution happened, you're owning X minus 20, X minus 30%. So even if the business does well, your returns are very inferior. The third is, is the management more knowledgeable than the outside world of the business? For example, if the management is very capable and knowledgeable about what the business shape can look like in a 3-year, 5-year out, if that vision is missing and the management is just focused on the near term, that is a business which we intend to, or we generally avoid as much as we can. So I think if they don't believe in a long-term story and opportunity of the business on a practical manner, not on Excel sheets, I think that puts us off very significantly.
Coming to Nippon India Large Cap Fund, it experienced some challenging times between 2018 and 2020. But since then, there's been a strong recovery. Could you shed some light on what contributed to this turnaround?
Interestingly, our belief has always been that there is alpha available in large cap, mid cap, small cap. So we always run a fund by taking high conviction calls in specific sectors or stocks. Which, if you recollect, the 2018 and 20 period was an extremely narrow market. Dislocated markets with the underlying construct being, interest rate will remain zero forever, and you can give any multiple to any company as long as you perceive it as a quality company. I think that was the market where only consumer stocks were valued at 50, 60 times the rest of the world, and certain private sector banks were valued at a higher level, and rest of the world was completely ignored. So you actually ended up getting maybe 60, 70% of the market in a disproportionate value zone. I generally call them bankruptcy valuation for a lot of high quality large businesses which are available, but they were not perceived at quality because their past 5 years were bad. So you could end up owning large public sector banks. You could end up buying the whole of engineering and manufacturing sector, all the world-class multinational listed businesses at very sensible prices. Uh, all these constituted, and the hospitality sector also. The whole, you could buy one, two, three hospitality companies in India at extremely below replacement cost valuations in most of this. So you had the opportunity to choose a good cross section of businesses. These are world class businesses and leaders in their own context in a bad cycle. And their valuations were even more depressed than normal because COVID led to a further sense of saying that these businesses won't recover. So I think our attempt was to see where people are giving up, because that's where the best value lies. And that's where the next cycle, the best returns really come. So I think that played very well. So it was public sector banks, it was engineering and manufacturing space across, and it was also the other sets of businesses like the hospitality space, which was like totally ignored, and extremely attractive valuations were available. So that enabled recovery. And also we took a stand that where there is disproportionate value, we have to have material overweights, obviously within the risk framework for the fund. But taking that stand in a bad cycle is, I think, what really helped. And hence our belief is, whether it's large cap, mid cap, small cap, there is an alpha opportunity over a rolling 3 year period if you're able to take stands versus the market. Hence, alpha is not constrained by capitalization, is our experience, at least I would say, in the last 20 years of managing money.
I have noticed that the portfolio of Nippon Large Cap and Nippon Multicap funds lean heavily towards sectors like services, financials, and capital goods. So, what is the strategy behind this allocation?
Yeah. So it was a construct of where relative attractive value was available, and significantly on an absolute basis was giving an opportunity. Services, if you recollect, had, especially the services which were like hotels and all, had very very difficult times till the last 3 years, right? And they're super, not 3 years, even for a 10-15 year period. So that cycle recovered. That cycle recovery was certainly to come in the next few years, because if you look at it, the whole domestic tourism opportunity was yet to unfold, right? So when you look at what's possible in the next 8-10 years, right, and what you're paying for to buy that business, it appeared like we were maybe paying less than 10-15% of the fair value for a lot of these businesses in a 5 year, 10 year horizon. That enabled us to services. Retail, for example, organized retail, which is also an important construct, has been in the last few years. It's very simple. Most of these businesses, people said the narratives were in the market that online will kill offline. Today, offline is having one of its best growth years ever, after 10 years of online invading India and trying to do discounting. So I think a lot of these narratives, when they happen in the marketplace, they happen generally against these services, these hotels, retail, capital goods. Capital goods, people said India will never become a manufacturing hub, or the recovery won't happen, and things like that. That changed. Hospitality sector, I've talked to you about zero investment because of a bad cycle. And then people said online platforms will come and take away market share, and existing physical hotel infrastructure will not be important. All these narratives actually enabled us to choose high quality, great businesses at very, very sensible prices. And a lot of them happen to be the services side. The real boom on services is just started, right? I mean, if you look at organized retail in many, many cities is less than 10-15% still, right? And I think the younger generation has a significant amount of wealth and affluence coming through, right? So that would enable a lot of growth there. So many of these were 10, 20, 30-year opportunity. People were buying and selling from a 2, 3 year point of view. And that mismatch in time frames allowed us or enabled us to create those portfolios.
Right now, Shailesh, before we conclude this chat, there's something that we would like to know from you. Throughout your distinguished career, you've made numerous investment decisions. What are the ones that that stand out for you as particularly the memorable ones, or that you're especially proud of?
Yeah. So thankfully, working across sectors enabled us to choose good number of businesses fairly early in this cycle. So, without taking names, some of the largest CRAM companies in India today, we had invested 15, 20 years back. In most of these years, we have been owning them. So, a lot of these businesses have been held for 15, 20 years also in our portfolios. And a lot of these businesses have compounded materially and grown from maybe a 200 crore market cap to even 1 lakh crore market caps. Similarly, in retail also, the very early stage investments today, these companies today traded about a 1 lakh crore market capitalization. They used to be about 1,000 crores or thereabouts at that point of time. So a lot of these sectors were young, which enabled these decisions to be taken as well. And and you just stayed with them. I think the single most important point has been staying with right quality businesses by after taking those decisions, because they just kept on gaining market share and getting prominence, and markets started respecting them over a period of time. A lot of multinational companies were available at distressed valuations. So owning them at when they were out of favor, that enabled things to work out. So that's how the journey has been. So it's been across sectors, opportunities which came up in smaller sizes and had a long runway to growth were actually important calls from there. On the market construct point of view, you had opportunities in high conviction sector calls versus what the market was putting their money on. So 2018 and all, it was only a one-sided market for a few set of companies. And you could actually put a large amount of your capital into others. So for example, Nifty, the top 10 companies were 67, 68% of Nifty, right? The remaining 40 were just 30%, 32% of Nifty. And there you could actually keep 70% of your capital and differentiate against what the market could present.
Sir, lastly, any misses in your career? You spoke about the hits, but any particular misses which which over the period, in the hindsight, you would love to invest in that particular sector or stock?
So a lot of them. So basically, it is natural. So the beauty of this market is it keeps you humble every day. So because you just know that whatever you know is still very limited from the context of what it is. There are a lot of times we have bought businesses for an X reason, we have got returns for the Y reason. Right, and it happens all the time, and I think that's why we have to keep ourselves changing our hypothesis or looking at the hypothesis which you need to be evaluating it very, very closely. So it has been across sectors. In a lot of sectors, we would have missed opportunities which have become way bigger, right? So even if the beauty of this market is you have to get 60% right, 70% right, and stay with what you get it right. So even if you keep doing it on a recurrent basis, I think the opportunity to create wealth is very, very large. So that's how the journey has been. Yes, there have been misses across sectors, and in many cases, you couldn't participate very early either because you were invested in some other areas, or you possibly didn't understand what that sector would really offer.
Well, time now for us to wrap up this chat. Thank you for taking the time out for this interaction. We hope our viewers benefit from the insights that you share. Thank you.
Thank you so much. Thank you so much for having me.